Hi, I'm Adam Khoo, and in this video, I'm going to show you how you can become a successful investor and build a multi-million dollar portfolio even on an average income. Because nowadays, learning how to invest is not just for people who want to be really wealthy, but it's for the average family who wants to protect what they have, who wants to live comfortably and have enough for retirement eventually. Because nowadays, research has shown that if you want to retire at 60 years old and live for another 25 years, you need at least 1.5 million in cash to just get by. So having $1 million itself is not even enough in today's world. Because nowadays you can work really hard in a job and earn a decent salary and have hardly anything left behind for retirement or for a rainy day. And that's because the cost of living is rising so much faster than the cost of our income. And that's why middle income people are struggling financially, not just poor people, middle income people. So what's the solution? The solution is not to work more hours because we already work so much. We need a life. The solution is not to get a higher paying job and stay in the rat race. The solution is learning how to build a portfolio of assets that can increase in value, that can magnify our wealth, that can generate passive income to sustain us for the rest of our life. You know, the great news is anyone can learn to become a successful investor. You can. Anyone can learn how to build a multi-million dollar portfolio even on an average income. Anyone can become financially secure, financially free, and do what they love in a couple of years with the right planning and the right strategy. I have done it, and so have thousands of my students. So I invite you to come along on this journey with me where I'm going to show you how you can get started. So my investment journey started 26 years ago when I was 18 years old. And I have to credit my grandfather. He's the one that got me interested in the stock market. See, when we were young, we would get red packets during Chinese New Year. It's a custom for relatives to give money to children. But my granddad did not give us cash. He gave us share certificates of the companies he owned that he would distribute throughout his entire life. And initially I was like, why isn't he giving us money? Why is he giving us all these pieces of paper, right? And my grandfather would educate us. He would say, if I give you guys cash, you're paid only once. But when I give you shares in a company, you now own a business. You are now a business owner. And I was like, wow, I'm a business owner, right? And my grandfather would say, a business is a money-making machine that can pay you for the rest of your life, that can increase in value. And you always say, don't just work for money. There's no end to it. Instead, own businesses, own money-making machines that will work for you. And I was fascinated. And from then on, all the money I got during Chinese New Year, the ang pao money we call it, I did not spend it. I did not put it into the bank. I put everything into the stock market. I even worked during school holidays. I worked on weekends because I was obsessed with investing. I took all the money, I put everything into the stock market. Because my grandfather talked a lot about Warren Buffett that inspired me. Warren Buffett started investing at the age of 11 years old. And I said, I'm 18. I'm like 7 years late. I got to catch up, right? And what fascinated me was that Warren Buffett became one of the richest men in the world. He built a fortune of $89 billion without ever starting his own business. All he did was buy shares of the best companies in the world. And so that's how I got started. And it was not an easy journey. When I started, I made all the stupid mistakes. I started with always buying the cheapest stock I could find in the stock market by reading the newspapers. So I remember I bought this stock that was 3 cents. And I said, it's so low, it can only go up. It's a deal of a lifetime. And I bought the stock at 3 cents. It went to 2 cents. I bought more. It went to 1 cent. I bought more. I said, it can't go lower than 1 cent. Guess what? It got delisted. It went bankrupt. I lost everything. So I learned the first lesson. Don't just buy stocks because they're cheap. Very often, low-priced stocks are of businesses that are lousy companies. So I learned the first lesson was to only invest in high-quality businesses, the best companies in the stock market. And they tend to have higher prices. So I started buying good companies. But again, I have this experience where I buy a good company and the share price still goes down. And I say, it doesn't make sense. It's a good company. Why is the price going down? And I realized it's because I bought a company when the price was overvalued. All right. So I learned that, hey, you can't just buy a stock. You have to do a valuation to know what is the true value of the company. Is it overvalued or undervalued? And we only buy when it's undervalued. So I said, fine, I'm going to focus on good companies that are undervalued. And again, I buy those stocks and the price went down again. I said, what's happening? Right. So I learned my next lesson, which was in the short term, the stock market is irrational. In the short term, the market is emotional. It's driven by news events, by greed and fear. So in the short term, stock prices, they go up and down. They've got nothing to do with the business. They've got to do with, events. And at the time the recession hit and the stock I bought was a good business, but the share price kept going down lower and lower. So I learned that, never ever buy on a downtrend. You have to read the trend of the market and only buy on an uptrend. So these were all the lessons I learned that, hey, number one, buy great businesses. Number two, buy them when they're undervalued. And number three, buy them when there's momentum, when the price is on an uptrend. And that's what I term value momentum investing. So only when I began to apply the principle of value momentum investing, of knowing what to buy fundamentally very good businesses, buy them on an uptrend, know when to exit my investment, knowing how to manage my portfolio, only then was I able to generate consistent profits. And I saw my wealth increase exponentially. Like most people, I started small with a few $100 and it became a few $1,000 and a few $100,000. The next thing I knew, I had $500,000 as a young kid. And then by the age of 26 years old, I managed to make my first million. And that was my first claim to fame. And I'm here to tell you that once you make your first million, your second, third, and fourth, and fifth million is a lot easier to make because you've learned the skills, you've learned how to do it. And like it or not, money makes money. The more money you have, the easier it is to make even more money. And that's how by the age of 31 years old, I was ranked the top 25 richest Singaporeans under the age of 40. And again, I'm saying this to you not to show off to you, but to tell you that, hey, if I can do it, anyone can do it. It took me, from 18 years old to 26 years old. It was about 9 years to make my first million, right? That's almost 10 years. And I tell people that you will also take 10 years to make your first million if you start from scratch, if you learn from your own experience. But it's better to learn from other people's mistakes and other people's experiences. So my job in this program is basically to show you how to cut short your learning curve and don't make the same stupid mistakes that I made, that most people make, and go around in circles. How do you learn the right principle of, again, value momentum investing to pick the best companies, to enter the best time, and know how to compound your wealth so you can build your financial security and your financial freedom as soon as possible. And being financially free myself has given me, again, the choice and freedom to do what I really love to do, which is to teach and to coach people from all around the world to become better investors. I've been running Wealth Academy now for 12 years, and we've had thousands of students coming through our program, many of whom had no investing experience, many of whom have actually made bad investment experience in the past, but within a year were able to make back their losses and make a positive gain in their portfolio. I still keep some of these emails that I treasure so much over the years, like William and Sharon, who came back in 2009, who said, Adam, we benefited greatly after attending your Wealth Academy seminar in January of 2009. It's almost 10 years ago. By now, we have recovered our losses of more than $50,000 and holding on to some good gains within just a couple of years. And this was an email sent by a reminder to his customers. And he has no relationship with me. I don't pay him anything. He's not even related to me, but he did it because he saw the impact that the program had on his customers. He said, in the last 2 years, I've had the opportunity to work with the graduates from Adam Khoo's Wealth Academy program. Many of them knew nothing about the stock market or had lost a lot of money on their previous portfolio prior to the course. I then witnessed how Adam's course on financial education changed the lives of people who learned and acted on his advice. They became more confident in the market and made good returns on their portfolios consistently. Recently, I've had students like Jing Hao who had, again, very little investment experience, but within the first year, you can see that he made from January 1st to December 31st an 84% return, on his portfolio, which is amazing for a beginner. And Chu Yanni, or we call him YY, came to the program about 2 years ago, achieved a 169% gain on his portfolio in 1.5 years. And in fact, after 2 years, which was 6 months later, he reported a 195.9% return on his brokerage account. I've had students from all around the world, from Vietnam. This lady called Tao, who said, I got a 100% return after 2 years investment from January 2016 and growing her portfolio 119% return over 2 years. And again, these are people who have never invested before. But again, learning about value momentum investing, picking the right stocks have made huge gains on their portfolio. But I tell people that, I'm going to really under promise you and say, don't even think about 100% return or 80% return or what my students are getting, because these are my top students. But if you can just get, a double digit return of, just 20% return or 25% return, you are beating most of the people out there in the stock market and are well on your way to build your $1 million portfolio. The great news is if you don't have the time to come all the way down to Singapore, Malaysia to attend my live Wealth Academy programs, you can now take the value momentum investing course on Piranha profits from all around the world. But before you enroll, let me tell you more about the program and share with you some strategies you can begin to apply right now for yourself. So if you really want to build your wealth, then the best investment you can make is in the stock market. Because when you buy stocks, you're buying an ownership in a business. And businesses grow much faster than any other asset. They grow faster than real estate or commodities or bonds in the long run. If you take a look at this chart, you can see that in the last 40 years, if you had invested $10,000 into the stock market, you have grown to $277,000. Compared to US homes that would have grown to $58,000. So in other words, the stock market has outperformed real estate by more than 4.6 times. And if you look at more affluent property like homes in Orange County that has grown from $10,000 to $126,000, the stock market has grown about 2.2 times more than even homes in Orange County. So stocks are the best builder of wealth. Now, how about bonds? When you buy bonds, you're essentially lending money to companies or lending money to the government. When you buy a stock, you are the owner of the business. So you can see that in the last 10 years, the stock market measured by the S&P 500 has returned 12.04% a year for the last 10 years, compared to corporate bonds that have returned 6.72% over that same period. So indeed, stocks are the best builders of wealth in the long run. So let's take a look at how your money grows over time depending on where you invest your money. Let's take an average salary of $5,000 a month. That's the average income of most Americans or Singaporeans for that matter. So $5,000 a month is $60,000 a year in income. And let's assume you just save 10% of your income. So that's $6,000 a year, okay? And let's assume that every year you will take that $6,000 and you will invest it into different assets. And let's assume you begin with a starting capital of just $10,000. How much money would you have after 20 years? Well, let's take a look. So if you were to invest your money in nothing, right? You put your money underneath your mattress or you just put it in your safe and you get 0% return, $6,000 a year would accumulate to $130,000 after 20 years. And at that time, things would be a lot more expensive because of inflation, okay? If you were to put that money instead into the bank, into a time deposit or CD, you get an average of about 2% interest rate. So at a 2% interest rate, you can see that you'll grow to about $160,644, which is basically this green line that you see over here, okay? If you were to put your money into corporate bonds, in other words, you are now lending money to companies and getting an interest rate. Corporate bonds return about 5 to 6% a year. So your money would grow to about $225,000, which is the purple line that you see over there. Okay, so these are corporate bonds. That's a time deposit, and the red one would be if it's not invested at all. Now, the big difference comes when you invest in the stock market. So if you were to just invest into an index ETF, which means you buy a basket of many companies and you just track the index in the long run, you're getting about 10 to 12% return. And your money would grow to $465,000 in 20 years, which is this line that you see over here. Now, the biggest difference comes when you know how to pick the best companies. Using, again, value momentum investing, buying the best companies when they're undervalued, when they've got momentum. All right? So we call this value momentum companies. And if you invest again in the best companies, you should get at least 25% return or more. Okay, you saw many of my students getting 60% return, 80% return, 100% return. But again, I'm not going to promise you that first. Let's begin with just 25% return. If you can do that, that's pretty darn good already. And at the 25% return, your money would grow to $2.9 million. Way more than what you need to retire with financial freedom and security at just saving 10% of your salary. So notice, let me ask you a question. In all these scenarios, were you investing the same amount of money? The answer is yes, you're just investing $6,000 a year. But why is the result so different from 2.9 million to 130,000? Because of the power of compound return. Compounding allows small money to grow into huge amounts of money over time. So the lesson to learn is, if you want to grow your wealth, don't just focus on how much you save, but focus on getting the highest possible return on your portfolio. Let's take a look at some real charts over here. So this is the S&P 500 ETF. So this is a fund, an ETF, that tracks the S&P 500, a basket of the biggest companies in the US. And you can see that in the last 10 years, investing in this ETF would have returned you about 12% a year on average. So we call this passive investing, because you don't do anything, you just buy and just hold it for the long run without much effort. And again, that's about 200% in 10 years. But if you were to pick the right companies that again are high quality, that have got good value, that have got momentum, one of the best examples would be Apple, one of the best companies in the last 30 years. So if you invested in Apple, 10 years ago, it was at $12 with the stock split being adjusted. Today, Apple is selling at $220 per share. So that's a 1,700% return in 10 years. And that's equivalent to a 33.75% return a year compounded. So that goes to show you that when you know how to pick the right companies, when you know when to get in, you can get returns much higher than just buying the ETF and just holding for the long run. But in the value momentum investing course, I'm going to teach you both approaches, both passive investing, buying and holding, and active investing, buying good companies, knowing when to get in, knowing when to get out. Now, some people ask, Adam, isn't investing risky? And the answer is, when you don't know what you're doing, everything is risky, including getting married. In fact, that's even more risky. Okay, I asked people, I said, if you don't know how to drive a car and you go drive a car, is that risky? Of course it is. There's a high chance you're going to get into an accident, you're going to get injured. All right. But what if you learn how to drive a car? What if you got your driving license, you drive defensively, you follow all the traffic signals, you've got your seat belt, you've got your airbags. Driving then becomes very safe. So the same thing is true for investing. People who don't learn how to invest but invest in the markets are like driving without a license. They will eventually get into an accident and get badly injured. But if you learn how to invest intelligently, investing is extremely safe. And I'm here to tell you this. Not investing and not knowing how to invest is the riskiest thing you can ever do for yourself and for your family. Because if you don't invest and you put your money under your mattress or in your safe, it will decline in value over time. Let's take a look at how inflation eats away at our purchasing power. Now, the current year is 2018. Okay, I don't know when you're listening to this, but right now it's 2018 as I'm recording this. Now, 20 years ago, in 1998, what was the price of a Big Mac? Well, Big Mac costs $2.50. Today, a Big Mac costs $5.51. So that's 100% increase in price in 20 years. Everything doubled in price, right? So with that same inflation rate, how much would a Big Mac cost in 20 years? Which means in 2038, it will cost double the price today at the same inflation rate, which means a Big Mac would cost $12 in 2038. Now, how about more luxury goods? Let's take a Nike shoe, for example, right? In 1998, Michael Jordan was the hottest thing in basketball. So, people bought the Air Jordans, and so did I. A pair of Air Jordans cost $65 in 1998. Today it's LeBron. Okay, no more Jordan, LeBron. Okay, so today LeBron shoes cost $180. So when you look at luxury goods like shoes and clothes, it's not double, it's triple, right? Prices have tripled in the last 20 years. So 20 years from now, if you want to buy that same Nike shoes, the cost is going to be 3 times the price today, which is going to be projected $498 for a pair of shoes. Okay, think about it, right? So take a look at this chart and you can see that since 1913 to now, the US dollar or any currency in the world, US dollar, Singapore dollar, British pound, whatever currency, because of inflation, is worth less and less. And in the last close to 100 years, the purchasing power of the dollar has fallen by 96%. In other words, if you had a dollar in 1913 and put it in your safe, today that dollar would just be worth, it would have dropped in 96% in value. Basically, what I'm saying is this. So think about this. If you have $20,000 right now and you don't invest it and you put it in a safe, in 20 years, it will be worth about $6,600 to $10,000. Why? Because everything will be double or triple in price. So that means that you're guaranteed to lose 50% to 67% of your wealth if you don't do anything about it. But if you can invest $20,000 at just a 20% return, not even a 25% return, at a 20% return, 20 grand compounds to $766,000 in that same period of time. So there's a big difference between knowing how to invest and not knowing how to invest. And that's why you notice that, hey, the rich are getting richer because they know how to invest. But the poor are getting poorer because their savings are eaten up away because of inflation. So I want to ask you a question. 10, 20 years from now, where do you want to be? Do you want to be the guy up there with a couple $1 million or the guy down here with a lot less in your bank? Where you be is not dependent on luck. It depends on the decisions you make today. Are you willing today to learn how to invest and to take charge of your money and to grow your portfolio with the right strategies? If you are, I'm there to help you to get there. All right, so how do you achieve over 25 to 50% returns consistently from the stock market? Well, the answer is that it's not that simple because there's no free lunch in this world. It's not just putting your money in the stock market and hoping it's going to go up. It doesn't work that way. In fact, I showed you that if you just take a passive approach to investing, just buying and holding the index for the long run, you're getting anywhere from 10 to 12% returns a year. So if you want to achieve a double-digit return, 25 or 50%, you have to put in a lot more effort. You have to learn how to pick the best companies that will outperform the market. And the way to do it is using the process of value momentum investing. And again, value momentum investing, it's about buying only the best businesses at the best prices at the best time, catching the momentum of the market. So there are basically 3 steps in value momentum investing. And step 1 is knowing how to identify the best companies in the market. And I'll talk more about it in the next slide. So once you identify the best companies, do you buy them? The answer is no. It's like you go to the shop and you find a great jacket, a great shirt, great material, great brand. Do you buy? No, you don't. You check the price. If the price is too expensive, you walk away. You wait for the sale, wait for the discount, right? So step 2 in value momentum investing is knowing how to value the stock. What is it really worth? Okay? And to only invest when the stock price is selling at or below the intrinsic value of the company. So only invest when the stock price is undervalued or fairly valued. Again, the trouble with pure value investing, some people, they buy stocks that are undervalued, but they become even more undervalued. And that's why you have to add in what we call momentum in the markets. You only buy when the stock is on a clear uptrend or at a support level on a consolidation. So you have to look at the emotions of the market as well to maximize your returns. And the third thing is this. Many people may know what to buy, when to buy, they don't know when to sell. So remember that a company doesn't remain a good company forever. A good company can become a lousy company. An uptrending stock can go on a downtrend during a recession or bear market. And you have to know when to exit to take your returns and to protect them. So you must know when to exit an investment when the company's fundamentals deteriorate, when the business is no longer a good business, or when the price is overvalued and goes into a downtrend. So these are 3 steps you're going to learn in the value momentum investing course. We're going to go into depth on exactly how to do that. But here's a quick lesson. Now, in any stock market, in the US, there are about 7,000 companies. All right, in Hong Kong, there are about 2,000 companies. Do we want to buy all the companies? Obviously not. We have a choice. We only want to buy the best companies. In fact, I only buy the top 3% of businesses in the stock market. The stock market is like a supermarket of companies where companies are on sale every day at different prices. So we go to the stock market, we only choose the best companies. So the best companies are the companies that we know over time will increase in value. And how do we know that? Well, there are a few things. Number one, the company must have a history of consistently increasing sales revenue, earnings, and cash flow from operations. Number two, we want the company to have a sustainable competitive advantage that protects it from competition. We call it a wide economic moat that comes from a brand monopoly, high barriers to entry, high switching costs, or the network effect. And in the course, I'm going to show you how within a couple of minutes, you can find these companies in the market using software screeners. Next, no matter how good a company is, you'll go through a recession, you'll go through bad times. So we want a good company to have low or conservative debt and a strong cash position. So again, in the program, you're going to learn how to analyze the financial statements, how to analyze a company inside out to know if it's a good business and what are the danger signs to avoid and where a company has got growth potential. Step 2, like I said, once you find a good business, you only invest when the stock price is selling at a discount to the fair value, when it's undervalued or fairly valued, and on an uptrend. Okay, Warren Buffett has a famous saying: "Be greedy when others are fearful, and be fearful when others are greedy." Now, if you take a look at any good business, you can see that over time, in the long run, the company will increase in value. For example, take a look at Procter & Gamble. P&G is a fantastic business. It's got a wide economic moat, a sustainable competitive advantage. So you can see in the long run, the green line represents the value of the company, the intrinsic value of the company. In the long run, you can see it always goes up. And again, in the program, you're going to learn how to calculate the true value of the business. Okay? So in the long run, the value always goes up. But in the short term, the stock price fluctuates up and down based on the emotions of the market, based on news like the China tariffs and the trade war and right? Whatever, nuclear, Korean war and all that, right? So what happens in the short term is during a crisis, a bear market, the price can go all the way down below the green line, below the intrinsic value. So it is undervalued. And sometimes when people are optimistic, the market is doing well, the price goes all the way up and it becomes overvalued. Does it make sense? So prices become overvalued and undervalued through market cycles. So you have to know what is the true value of the company, and you only buy when the price is selling at an undervalued level, when it's below the green line. That's when you buy. And you do not buy when the price is overvalued. Okay? Now, having said that, let's take a closer look. You can see over here that the price is undervalued, right? Because of the financial crisis, the price has gone below the value. Now, if you buy here, what would have happened? That's right, it's cheap, but cheap gets cheaper. Because on a downtrend, low gets lower. So besides just looking at valuation, we have to also read the trend of the market. Is it bullish or bearish? So we only want to enter here, for example, when it is undervalued and on an uptrend. So we catch the trend all the way up. And when it's overvalued and on a downtrend, we can quickly exit and lock in our profits, wait for it to crash again, get undervalued again, start a new uptrend and buy it back again. So by learning how to time your entries, you can maximize your returns and get, again, 30, 40, 50% returns more than most people who just simply buy and hold the stock. Here's another example. Alphabet owns Google and YouTube. And again, this is a fantastic business. In the long run, you can see the green line represents, again, the intrinsic value. And it always goes up in the long run. But again, the share price is driven by the short-term emotions of the market, all right? Where it becomes undervalued, overvalued, right? And so on and so forth. Overvalued, undervalued, overvalued, undervalued, overvalued, undervalued, overvalued. So again, anything above the line is overvalued. Anything below the line is undervalued. So again, in the program, you're going to learn how to know when it's undervalued, to accumulate the stock when it's undervalued, and on an uptrend. And again, that's how you maximize your returns with this approach called value momentum investing. And again, through the years, when my students have applied this method, they were able to increase their wealth exponentially. One of my students, his name is Thomas. He was in a Singapore Air Force. He knew nothing about investing and decided to start investing to build his retirement portfolio. And he started with $10,000 and he grew it to $18,000 in 1.5 years. Now you may say, Adam, $8,000 is no big deal. Yeah, but in terms of percentage, he got an 80% return in 1.5 years. And that's better than most people, what they can get by putting into the bank or into a bond, all right? One of my very old students, Wei Ping, came to the program about 10 years ago. And he was featured for being one of the biggest online traders today back in July 2014. From the confines of his bedroom, right, he turned $20,000 into $1 million in net profit. And that, again, is a fantastic return. And Bang Pham Van, who is from Vietnam but works in Singapore for one of the multinational corporations, he's a senior executive. He said, "Hi Adam, I thought I'll drop you a note to let you know that my stock trades have been quite successful. Reapplying the techniques and tips I've learned from Wealth Academy a month ago, my profit last month has paid the course fee 7 times over." And you can see from the brokerage statement, he had 105% return in just 9 months. So again, I'm not saying that everyone can do this. I'm not saying they can do it every single year. What I'm saying is my top students are getting huge double-digit returns. But if you just follow the simple principles of value momentum investing, you can do a lot better than most people out there. Another student of mine is Felix from Penang, Malaysia, and he got a 59.57% return in his first year of investing right after the Wealth Academy program. So through all these experiences, I'm so convinced that anyone can do it. I've done it, my students can do it, you can do it as well. So the great news is you can now learn this skill of investing, of value momentum investing, through the Piranha Profits online value momentum investing course. And you're going to essentially take my 26 years of experience and learn it in a short period of time. And it's an unlimited program. You can watch it for as long as you want to. And they're all together going to be 11 lessons. The first lesson is going to be about stock market basics. So if you know nothing about the stock market, we're going to get you started to understand how the stock market works. What is the stock market? What is a stock? What drives prices up and down every single day? You'll be learning, again, the value momentum investing approach, where value plus trend maximizes profits. And you're going to learn all the ways where stocks can build your wealth through dividends or through capital appreciation. In lesson 2, you'll be learning the simplest way to make money from the markets, which is investing in ETFs, exchange traded funds that track market indexes or sector indexes. So you're going to learn how to invest in ETFs and how to build an ETF portfolio. Again, when do you enter and when do you exit ETFs in investing. Lesson 3, you'll be learning the 3 steps of successful investing. Again, identifying the best companies in the market, how to buy at discounted prices, and how to find the optimal entry point to maximize gains. On to lesson 4. In lesson 4, you learn all about how to analyze businesses, how to identify great companies by reading financial statements, income statements, balance sheets, and statements of cash flow, even if you've got zero accounting background. As long as you understand simple English, You will learn exactly how to be an expert reading financial statements. How do you identify growth potential and danger signs in businesses? Which businesses to avoid? And how do you use software to screen for the best businesses in the market that have all these fundamental characteristics, the top 3%, if you will. In lesson 5, it's really important. You'll be learning how to value a stock. Is it expensive or is it cheap? You'll also be getting my intrinsic value calculator to help you to calculate the intrinsic value of any company using the discounted cash flow method, discounted earnings method, the PEG ratio method, and the price to book ratio method. How to analyze any kind of business. Lesson 6, you'll be learning how to time the market with technical analysis. How to maximize returns by timing entries and exits. How to identify market trends and cycles. How to utilize support and resistance levels, and how to use moving averages to determine changes in trend. Alright, in lesson 7, we'll be putting everything together. This is where you're going to learn the secret sauce to becoming a fantastic investor. The 7-step investment formula. How do you master the 7 steps? And you'll be looking at a lot of case studies as well. I'm going to show you how to apply this technique to not just the US market, but to any market in the world. And we're also going to look at the Hong Kong markets, a market where I think there's tremendous value and growth opportunities right now. In lesson 8, you'll be learning how to build and maintain a winning portfolio. You'll be learning about the importance of diversification, how do you build a low-risk, high-return portfolio with optimal asset allocation techniques, learning about defensive versus cyclical stocks, and the 7 stock investment categories. Lesson 9, you'll be learning where do I find the best investment opportunities in the market today. How do we use things like stock screeners to find the best stocks, the best industries, the best ETFs? How to manage your portfolio, and again, when do you exit an investment to maximize your returns? Lesson 10, one of the most important lessons, the psychology of winning investors. Psychology is 70% success. Strategy is just 30%. With the wrong mindset, the best strategies cannot make you wealthy. So you'll be learning what is the winning psychology used by the greatest investors in the world. And finally, lesson 11, how do you choose the right stockbroker for yourself? And how do you use the trading or investment platform to buy and sell stocks from anywhere in the world? So again, it doesn't matter where you are. You could be in Singapore, in Timbuktu, in Africa, in India. You can invest in the best markets in the world, whether it's in the US or in China, using online brokers. You'll be learning how to place and manage your investments. So this is a brand new course called the Value Momentum Investing course. Enrollment starts on the 12th of October 2018. And for the first 50 people who enroll, you'll be given a special discount of this fantastic program. This is Adam Khoo. I'm so excited to share this with you, and I look forward to coaching you. May the markets be with you. Take care and see you soon.